You want to turn your money into a massive passive income machine. Dividend investing might be the secret weapon, but it's just not about buying stocks that pay out cash. It is a strategy. And in today's video, I'm going to break down the 5 essential dividend tips that can really help your portfolio go from average to absolutely unstoppable. Now, whether you're brand new or already investing with M1 Finance or Robinhood, these tips can help you really avoid rookie mistakes in building this long-term wealth. So stick around to the end of this and we'll have a bonus tip in here as well. Now, the first tip that we focus on the dividend growth, not just the high yield. This is where a lot of people get completely burned. When it comes to high yield dividends, it's very attractive, but it can be misleading when it comes to a company. Some stocks yield 8 to 10% return, but that could also be a red flag. This is where you do have to do your own really research. Looking at the company might be over leveraged, could be declining, could have some financial issues that they're trying to raise some capital. Instead, we want to prioritize dividend growth. Look for companies that have increased their dividends year over year for at least 5 to 10 years. And looking at a perfect example of this is when you think of Johnson & Johnson, Coca-Cola, PepsiCo, Procter & Gamble. They have a very consistent and a very long track record of growing dividends on a regular basis. So not only is the company increasing in value, but your dividends are increasing as well. Your returns over time start to compound. And the bottom line, chasing dividend yield sometimes can get you burned. Growing income really does build wealth. Now, the second tip in here is understanding the payout ratio. This is another one that is very important. The payout ratio tells you how much a company earns and how much goes towards dividend. The ratio over 80% means the dividends are probably and honestly unsustainable for a company. Ideally, you want a payout ratio of about 30 to 60%. It gives the company room to reinvest some of the money while continuing to pay dividends. Now, historically, when we see this, a company has two options. When they create profits, number one, they can put it back into the company, or number two, they can distribute it to the shareholders, or they can do kind of a variation or both of these. So when we start thinking about the payout ratio, if a company earns $5 per share, if it pays out $1.50 dividends on those shares, the payout ratio of that company is 30%. That is solid. Now, of course, if it is too high, it could risk not only being cut, but the company might not be on paper as stable as you might think. If it's too low, the dividend or the company might not be shareholder friendly. So balance is the key when it comes to the payout ratios that we have. Now, number three, reinvesting your dividends or the drip strategy. When we start looking historically when it comes to the stock market itself, reinvesting is what really gets the compound interest going. And when we look at the total return of the stock market, dividends are huge. Do not cash out the dividends, reinvest them. Now, there might be a point in life during your retirement years, taking out some of the dividends does make sense. But when you're growing a portfolio, you want them to be reinvesting and you want this on a regular basis. Now, using a dividend reinvestment plan or a drip plan, you can automatically buy more shares of a company with the dividend payment. So think about this. You invest in a company, they pay you dividends, it drip or reinvest right into the company, then they pay you more dividends. As the dividends continue to grow over time and that dividend snowball gets larger, you're owning more and more shares of the company through the dividend payout. And this is where the snowball effect really does take effect. This is exponential growth. And this is where, thanks to compounding, it really makes a difference. So when we think of an example with this one, if you have $100 in dividends, you reinvest it into a stock that also pays the dividends, you're earning dividends on your dividends the next time around. That is how investors grow the portfolio. Thinking of Warren Buffett at 65 to 95, dividend reinvestment was massive. It is an especially strong strategy when you're starting out young. The fourth tip in here, diversification. I cannot really preach this enough. When it comes to my personal portfolio, I hold a kind of a foundational, which is our VOO, the Vanguard S&P 500. I own something that is very heavy, a little bit more risky in the growth section with that NASDAQ 100. And then the third part of this, I actually hold in the dividend portfolio, which is through that Charles Schwab US dividend equity, making sure that we do have a little bit of dividends. Now, for the percentages, it's going to be a little bit later and really just a little bit different depending on where you are. For instance, right now, I only have 15% going into the dividend portfolio that we have right now because I am trying to grow the portfolio size-wise, value-wise, as fast as possible before we switch over and get some of the dividends. Now, dividend and really diversification, like we were talking about, don't rely on one sector. When you look at utilities, when you look at REITs, a lot of them perform and really prefer a lot of dividend growth. If the sector takes a hit, your income can absolutely get crushed. This is where diversification through ETFs or going for different industries when you look at consumer staples, really financial, healthcare, energy, some of the really big ones that are staples, 20, 30, 50 years of paying dividends, and even some of the tech stocks do pay dividends versus reinvesting the funds. The knowing when you look at some of the dividend ETFs, like the HD, we have the VIG, the DGRO, instant diversification, low fees associated with those, and you're getting a pretty good return. Now, tip number 5, mind the taxes. This is another one where a lot of people don't talk about it when it comes to YouTube. Dividends are taxed and often much higher than long-term capital gains. If you're investing in a taxable brokerage account, the dividends and the taxation of those dividends will go ahead. It will eat up your returns. So how can you get around this and really making difference? Holding dividend stocks in a Roth IRA means the dividends are going to be complete tax-free. If you're holding it in a traditional IRA, in the Roth, like I said, you do not pay tax on the growth, do not pay tax on the gains, the dividends ever. With your traditional one, the taxes are deferred, just like we see with the traditional IRA or the 401k. The money grown in there is tax deferred until you do the withdrawals, then you're taxed at that point. Now, understanding the tax strategies and really understanding what money you're getting from these dividends is going to make a big difference. And like I said earlier, promising the bonus tip, avoid the dividend trap. This is one that a lot of people really get burned, including myself. Just because a company is paying a high dividend doesn't mean it is a healthy company. If the stock price is dropping faster, dividends staying high, this could be a trap. There could be a couple things, and the company essentially could either cut the dividend or they could get bankrupt. Now, some of the warning signs, number one, having very high debt. We've seen this with Bed Bath & Beyond and a couple other companies that had a very high red flag when it came to debt, ultimately going bankruptcy. Declining earnings. How are they paying a high dividend, and how do they continue paying that high dividend when the money they're generating and the earnings they are having is absolutely declining? And we even see some companies that are paying out dividends when they are in a negative cash flow situation, which again is kind of crazy. Always do your research when it comes to dividends. Dividend investing is about stability within the market, not speculation like we see with some of the crypto investments. So there you have it, guys. That is 5 essential dividends. Really help you build that long-term wealth, consistent wealth. Let me know in the comments which of these 5 tips did you find the most helpful? Are you already using any of these? And do you invest in dividends? Now, if you got any value from this video, definitely like it and subscribe. Hit the notification so you can get the tips every single day with the companies that we're talking about. And if you're serious about dividends, really check out some of my videos because we have a lot in that investing section that is really covering stocks, ETFs, and dividends itself. And of course, thank you guys for watching.